Deadweight tonnage, same destination, Rotterdam. One cargo sells for $68 a barrel. The other sells for $49. That is a $19 gap. On a 2 million barrel VLCC, that's $38 million. Gone, vanished. Not because anyone negotiated poorly, not because the market moved against them, but because one barrel was Brent and the other was Bonny Light, and the market treats them as completely different products. This is the final episode of Crude. 300 million years ago, through the hunt for it underground, the engineering to extract it, the networks to transport it, and the infernos that refine it. The billions in infrastructure, it all converges on a single number, the price. And that number is not arbitrary. It is the product of a hidden formula that few outside the industry understand. Oil has one price. They check the news, see a headline, crude falls to $72, and assume that applies to every barrel on Earth. Dozens of benchmarks and a pricing architecture designed over 60 years that determines exactly what your barrel is worth. Understanding that architecture, you are playing a game where the other side already knows the score. Let's break this down. Before we talk about benchmarks, before we talk about pricing, you have to understand why two barrels of oil are never the same. And it comes down to two. American Petroleum Institute. The higher the number, the lighter the crude, the more of it floats on water than to gasoline. Most crude falls between 15 and 45 degrees API, and this number is not academic. It determines everything about what that barrel is worth. A light crude, say 40 degrees API, produces more gasoline, more diesel, more jet fuel from every barrel you run through a refinery. A heavy crude at 22 degrees API produces more residual fuel oil, more asphalt, more petroleum coke, products that sell for far less. The difference in refinery yield can be 20 to 30% of the barrel's value. That is the first variable in the hidden formula. Now here's where it gets critical. The second variable is sulfur. Sweet crude contains less than 0.5% sulfur. Sour crude contains more, sometimes much more, 2, 3, 4%, and sulfur is expensive. Every molecule of sulfur that enters your refinery must be removed, processed, and disposed of. That requires hydrogen, that requires hydrotreaters, that requires capital. Sweet crude commands a premium because it skips a step, or at least lightens the load on the refinery's sulfur handling infrastructure. Now combine these two variables. A light sweet WTI, the American benchmark, is around 40 degrees API and 0.3% sulfur. Brent, the global benchmark, is around 38 degrees API and 0.4% sulfur. Both are light and sweet, both command premium prices. But heavy sour crude, say 24 degrees API and 3% sulfur, trades at a deep discount. The market is not punishing that barrel, it is pricing the cost of processing it. This means the price of oil is a fiction. What exists instead is a two-dimensional matrix. On one axis, API gravity. On the other, sulfur content. Every crude grade sits somewhere on that matrix, and how close it sits to a benchmark determines its price relative to that benchmark. This brings us to the next point. Three benchmarks price the vast majority of the world's oil. If you understand these three, you understand the architecture of the global oil market. If you don't, every price you see is missing context. Brent, named after the Brent oil field in the North Sea, discovered by Shell in 1971. Brent is not a single crude stream anymore. The original Brent field stopped producing years ago. Today, the Brent benchmark is a basket of 5 North Sea crudes: Brent, Forties, Oseberg, Ekofisk, and Troll. Together, they form BFOET, the Brent complex. This basket prices roughly 60% of all internationally traded crude oil. When you hear the price of oil on the BBC, on CNN, in the Financial Times, they mean Brent. Why? Because it is waterborne. Brent loads at offshore terminals in the North Sea. It can be shipped anywhere. It is not landlocked, not pipeline constrained, not captive to one market. That geographic flexibility makes it the global benchmark. WTI West Texas Intermediate, the American benchmark, lighter and sweeter than Brent, around 40 degrees API, 0.3% sulfur. Physically, WTI is a higher quality crude, but it has a geographical problem. Pipeline hub in the middle of the North American continent. A barrel of WTI at Cushing cannot reach the global market to the Gulf Coast. That constraint means WTI often trades at a discount to Brent despite being higher quality. The WTI-Brent spread is one of the most watched numbers in energy markets. When it widens, American producers suffer. When it narrows, they profit. And in extreme events, like the 2011 to 2014 shale boom, when Cushing storage filled to capacity, WTI traded at a $25 discount to Brent. The oil was identical. The location was everything. Dubai/Oman, the Middle Eastern benchmark. Dubai crude is produced in the emirate of the same name. Oman crude is produced in, obviously, Oman. Together, they anchor the pricing of crude that flows from the Persian Gulf to Asia, roughly 18 million barrels per day. Dubai is a medium sour crude, around 31 degrees API and 2% sulfur. It is lower quality than Brent or WTI, but it prices the barrels that matter most to Asian refineries: Saudi Arab Light, Iraqi Basra, Kuwait Export, Iranian Light. Now here's where the architecture gets interesting. These three benchmarks do not exist in isolation. They form a triangle. The spread between Brent and Dubai tells you whether Asian demand is pulling crude east or Atlantic supply is pushing crude west. The spread between WTI and Brent tells you whether American production is backing up inland or flowing freely to the global market. And the spread between Brent and every other crude on Earth, from Nigeria's Bonny Light to Venezuela's Mare, is calculated relative to this triangle. This brings us to the mechanism. If you produce a barrel of crude that is not Brent, not WTI, not Dubai, and that's most of the world's crude, your price is not set by a headline. It is set by a differential. A differential is the discount or premium your crude trades at relative to the benchmark. And the differential is where the money is made and lost. Bonny Light, a light sweet crude, around 33 degrees API, low sulfur. So Bonny Light typically trades at a slight premium to Brent, say $1 or $2 per barrel. The Nigerian government bases its budget on that differential. The national oil company prices its cargoes against that differential. The traders who buy Bonny Light hedge their exposure against that differential. Now imagine a disruption, a pipeline attack in the Niger Delta, a dispute over export allocations, a force majeure declared on Bonny Light loadings. The differential can swing dramatically. A premium of $2 can become a discount of $5 almost overnight. On a cargo of 1 million barrels, that's a $7 million swing. The Brent benchmark hasn't moved, but the Nigerian producer is now receiving $56 instead of $63 for the same quality of oil. That is the power of the differential. The same logic applies everywhere. Saudi Arab Light prices against the Dubai/Oman benchmark. Russia's Urals prices against Brent at a discount, reflecting its higher sulfur content and the logistical premium of moving crude from Siberia to European or Asian markets. Canada's Western Canadian Select, a heavy sour crude, trades at a discount of $10 to $20 against WTI, reflecting the cost of diluting it for pipeline transport and the complexity of refining it. This is what the hidden formula looks like in practice. Start with the benchmark, Brent, WTI, or Dubai. Adjust for quality, API gravity, and sulfur content. Adjust for location, transport costs from the loading terminal to the refinery gate. Adjust for market conditions. Is supply tight or flush? Is your crude competing with a sanctioned barrel looking for a buyer? The result is the differential, and the differential is your price. Now here's where it gets critical for anyone in the industry. Differentials are not set by a committee. They are discovered through trading, daily, hourly, in real time. Physical cargoes are bought and sold. Paper contracts for future delivery are traded on exchanges. The interaction of these two markets, the physical and the paper, generates the price. And that interaction creates enormous opportunities for those who understand it and enormous risks for those who don't. If you only understand the physical market, the tankers, the pipelines, the storage tanks, you understand half the story. The other half happens on screens, on exchanges, in futures contracts that represent oil that will never be physically delivered. Brent futures trade on the Intercontinental Exchange in London. WTI futures trade on the New York Mercantile Exchange. Together, these two contracts see billions of dollars in notional value traded every day. Majority of these contracts are not settled by delivery. They are settled in cash. The trader who bought 100 lots of Brent does not expect 100 tanker loads of crude to arrive at Rotterdam. They are expressing a view on price direction. They will close the position before delivery, taking the difference in cash, profit or loss. This is not speculation in the pejorative sense. It is the mechanism that provides liquidity to the market. The airline that needs to hedge its jet fuel costs needs someone on the other side of that trade. The refinery that wants to lock in its crude costs for the next quarter needs someone willing to take the other view. The paper market provides that counterparty, but the paper market does something else, something with real consequences in the physical world. It sets the benchmark. When a Saudi cargo is priced against Brent, the Brent price is not discovered at a physical terminal in the North Sea. It is discovered on the ICE exchange in London by thousands of traders, algorithms, and institutions buying and selling contracts representing oil that will never see a ship. The physical delivery mechanism exists as a backstop. It ensures the paper price cannot diverge too far from physical reality. But day to day, minute to minute, the paper market sets the price that the physical market follows. Now, within the paper market, there is a specific spread that deserves attention because it ties episode 7 to episode 8. It's called the crack spread. Remember the refinery, the city of fire and chemistry? The crack spread is the difference between the price of crude oil and the price of the products that come out of the refinery, primarily gasoline and diesel. A simple crack spread is crude versus gasoline plus heating oil. A more complex one reflects the actual yield of a specific refinery configuration. When the crack spread is wide, refineries print money. They buy crude at the benchmark price, run it through their units, and sell the products at a premium that covers their costs and delivers a margin. When the crack spread is narrow or negative, refineries lose money on every barrel they process. They slow runs, they schedule maintenance, they shut units, and when they do, crude demand drops and the benchmark falls further. The crack spread is the hinge between the refinery and the price of crude. If you understand nothing else about oil pricing, understand that crack, the spread between input and output, is the refinery's profit signal, and the refinery's decisions move the crude market. Everything I've described, the benchmarks, the differentials, the paper market, operates within a framework that geopolitics can rewrite overnight. When the United States imposes sanctions on Iranian crude, Iran's barrels don't disappear. They go somewhere at a deeper discount. When sanctions hit Venezuela, its heavy crude finds buyers in China and India, but at prices that reflect the risk of doing the transaction. When the G7 imposes a price cap on Russian crude, you get one of the most extraordinary pricing experiments in the history of oil markets. Let me give you a real example. Before the 2022 invasion of Ukraine, Russia's Urals crude traded at a modest discount to Brent, roughly $1 to $3 per barrel. It was a medium, sour crude, but it was reliable, well understood, and integrated into European refinery slates. After sanctions, after the price cap at $60, after European refineries stopped buying, Urals traded at discounts of $20, $25, sometimes $30 per barrel. The same crude, the same API gravity, the same sulfur content, but the buyers had changed, the logistics had changed, the insurance had changed, the risk premium embedded in the differential had exploded. This is the lesson. The formula I've described, benchmark plus quality adjustment plus location adjustment plus market conditions, is not fixed. It is a framework. And when geopolitics intervenes, every variable in that framework can shift simultaneously. A crude that was premium yesterday can be distressed today. A trading route that was routine last month can become impossible this month. Underwater next quarter because its crude slate has been disrupted and its product markets have been thrown into chaos. Consider what's happening right now, in real time. The Strait of Hormuz, through which roughly 20% of the world's seaborne oil transits, is a geopolitical fault line. Any disruption there, a military escalation, a mine-laying campaign, a targeted strike on a tanker, doesn't just raise the headline price of Brent. It reshapes every differential in the system. Middle Eastern crudes that normally flow to Asia through Hormuz suddenly need to be rerouted. The cost of that reroute gets priced into the differential. Asian refineries that depend on Saudi and Iraqi crude suddenly face a supply gap. They bid up alternatives: West African crudes, American crudes, Russian crudes. Those alternatives see their differentials tighten. The entire pricing matrix recalibrates around a single choke point. This is what makes oil pricing simultaneously rational and chaotic. The formula exists. It is knowable, but the inputs change continuously, often violently. And the people who make money in this business are the ones who understand the formula well enough to know when it's about to break. Africa produces some of the highest quality crude on earth and some of the most complex to price crude in the market. This matters because the continent's oil revenues fund governments, build infrastructure, and shape geopolitical relationships, and those revenues are determined by the differentials I've been describing. Nigeria's Bonny Light is a light, sweet crude, prized with minimum sulfur handling cost. It typically trades at a premium to Brent. Nigeria's Forcados is slightly heavier but still commands a strong price. Angola's Girasol, Cabinda, and Dahlia are medium sweet crudes, well suited to complex refineries, particularly in Asia. Algeria's Saharan blend is among the lightest and sweetest crudes in the world, 45 degrees API, near zero sulfur, and it trades at a premium that reflects that quality. But Africa also produces crudes that price at the other end of the spectrum. Chad's Doba blend, medium gravity, higher sulfur, trades at a discount. Congo's Geno is heavier still. The spread between the best and worst African crudes can exceed $15 per barrel. Same continent, same underlying geology, completely different market value. And here's what makes African crude pricing particularly volatile. Production is often offshore, in deepwater fields, with high operating costs. A sustained decline in the benchmark, Brent falling from, say, $80 to $55, doesn't just reduce revenue. It can make entire fields uneconomical. The differential might hold, but the absolute price collapses, and with it, the economics of extraction. This is the trap. Producing premium crude does not protect you from a bear market. It only gives you a head start in a race where everyone is moving backward. There's another dynamic specific to Africa: export infrastructure. Nigeria's export terminals have been disrupted repeatedly by pipeline vandalism, by community unrest, by maintenance failures. When Bonny Light goes under force majeure, meaning the producer declares it cannot meet its contractual delivery obligations, the differential collapses. The same crude that commanded a premium last week is now unavailable, and the buyers who depended on it scramble for alternatives. When the terminal reopens, the premium doesn't automatically return. The market remembers the disruption, and it prices in the risk of the next one. This is the reality for African producers. The cost of your operations, and in the global oil market, reliability has a price. Version for textbooks, the real one, the one that traders and refiners and producers live by every day. Your barrel's price equals the benchmark plus or minus your quality differential plus or minus your location differential multiplied by the timing of your sale, adjusted for the counterparty risk of your buyer, hedged against the paper market's expectation of where the benchmark will be in 30 days, and overlaid with whatever geopolitical premium or discount the market is applying to your country of origin at this moment. Not at the moment you loaded the cargo, but at the moment the cargo arrives, because oil is priced at destination, not at origin. That formula is not written down anywhere. It lives in the heads of traders who have been doing this for 30 years. It lives in the pricing models of refineries that process millions of barrels. And it lives in the budget assumptions of governments whose survival depends on getting it right. And here is why this matters to you, whether you're a trader, a student of maritime economics, or someone who fills up a tank and wonders why the price changed since last week. Every dollar that moves in the crude market moves because of a variable in that formula. If you don't know which variable moved, you don't know why the price changed. And if you don't know why, you cannot predict what happens next. The difference between reacting to prices and anticipating them is the difference between surviving in this industry and building wealth in it. This has been Crude. 8 episodes, 300 million years of geology, the hunt for oil beneath the earth, the engineering to bring it to the surface, the pipelines and tankers that move it across oceans, the refineries that transform black soup into the fuel that powers civilization, and finally, the hidden formula that prices every barrel. Oil is the most complex commodity on Earth, not because the molecule is complex, it is, but that's episode 1. Because the system is complex, geology, engineering, logistics, chemistry, geopolitics, and finance, all compressed into a single number on a screen. Job, you now see that number differently. You see the 300 million years behind it. You see the billions of dollars at risk. You see the hidden formula. I'm Christopher Itek-Boje. This has been the Crude series on SeaMayors. If you've stayed with me through all 8 episodes, thank you. If you're finding this one first, the full series is in the playlist below. Start from the beginning. The story makes more sense that way. Drop your thoughts in the comments, and especially if you're in the industry. What crude grade do you trade or process? What differential keeps you up at night? The real knowledge in this field lives with the people who do the work. And if this series has added to your understanding, subscribe. There is much more to cover. Maritime economics, oil trading, shipping operations, the infrastructure that keeps the global economy alive. SeaMayors is just getting started. See you in the next one.